we like to be really transparent with our tenants. We talked about our new purchase price, what we bought the building at, what that then does for our real estate taxes, and our mortgage amount. We don't give them the exact mortgage amount, but because we bought it at a higher price than what the current owners had, we have to pay a higher debt service. So we're very transparent about real estate taxes and purchase price, and then we come to them and say, hey, one bedroom, one bath in this same neighborhood are going for, at the time, it was about 30. Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm your guest, Real Estate with Micah, and with me, as always, is your hosts, Tom and Mark.
There it is.
Nice.
That's what we needed.
Yeah,
there you go.
good.
You're off
Perfect.
the hook
Awesome.
now.
All right, man.
MBOA event, summer soiree last night. We're recording this the Friday after.
Man, what an amazing event! Just everything, like the I've never seen a event space like that. That was an amazing space.
That was amazing. I was going to ask Glasser how he came up with that one, but great job, that whole team. Great job. Rumors there's over 700 people there. So just phenomenal job advertising it. Had to be a good fundraiser, and just the event, the atmosphere, the vibes. That was fantastic.
The AC, the inside, the outside, all the different rooms. Like it was almost felt like a club in a way.
Yeah, that was really cool. So hats off to the MBOA. If you don't know the MBOA, please go check them out. Please help support. It's super, super important if you plan to be investing in Chicago.
Yeah, no, if I always tell people, if you're not going to support financially, at least go to mboachicago.com and get their newsletter. That way you're always on top of the hottest topics if you're not hearing it here first.
And then go to the other meetups. There's so many different affiliate, I'll call them affiliates or groups. There's just so much information out there. And if you're not taking advantage of it, that's on you.
Man, the event last night, the attorneys, the aldermen, just the amount of people that were there, the variety of people. We said this leading up to the event, but it always shocks me just the amount of people that they're able to put in a single space.
It's always shocking to me, the people you can make two steps, talk to someone, 2 steps, talk to someone. And then someone introduces you to someone that you've never heard of before. And it's oh, this guy's a killer. Right? It's just whoa, where have you been?
Yeah. No, we got some good guests lined up, I guess, from last night. I was handing out, I was talking to a bunch of people we know too, try and get back on the show. But man, we got, I made some great connections last night. And the best part was a lot of the people I made connections with were previous guests that introduced me to people. So the whole networking thing just kind of keeps giving.
Yeah, this thing works.
This works.
All right. How about we get to a housing provider tip of the week? What do we got?
All right, so housing provider tip of the week. Right now, you're probably listening to this. I think it'll probably be around September. One thing I see landlords make the mistake with housing providers is they leave the AC units. They might have a boiler, and their tenants are putting the window units in. They're leaving them in the windows throughout the winter, which obviously will affect your heat bill. So whether it be forcing your tenants to take them out seasonally, or having your maintenance guy go through and pull out your window ACs to make sure that your heat that's already fairly inefficient in your 140-year-old building is not leaking any more energy out that window where that AC unit is.
Awesome. All right. Let's get our guest in here.
All right, man. So today's guest, a young, aspiring guy with, good volume. We already declared that. And then definitely someone up and coming here in Chicago. So without further ado, Micah White, man.
Yeah, thanks for having me. I'm excited to be here.
I think you and me started talking on Instagram. You have a great energy, and I'm excited that you're going to bring that here onto the show today.
Yeah,
So,
I appreciate it. Started that page just about 2 months or so ago, and we're picking up traction. We're trying to put out a video every day, and it's tough, but it's fun.
Nice. All right, man. So talk to us. You have a background that we usually don't have on it. You actually went to school for real estate. And I always tell people man, they didn't even have that 25 years ago. You could actually go get a degree in real estate and so forth. So now they actually have it in property management. But talk to us. What made you get into that? Are you from here? Where are you from?
Yeah, so I'm from Indianapolis, Indiana. Grew up a Hoosier, always a Hoosier. Ended up going to Indiana University, and I came in as a marketing major. So far from what I graduated as, but kind of learned quickly that I'm not as creative in the marketing aspect as I previously thought I was. But I took an intro to real estate analysis class, and that sort of opened up my eyes to all the paths that real estate provides, right? I thought you can be a real estate agent. But beyond that, I didn't know of anything else, right? Development, property management, actually investing in real estate. And so this class that I took really opened up my eyes, and it sort of made me switch my major to real estate and finance, and did my 4 years there, graduated with a double major in real estate and finance. And here we are.
You moved to Chicago, though.
I did.
That's what we love about Chicago is it's got the proximity to all these Big Ten schools that. Was it just you? Did you maybe your roommates? Everyone kind of moved here?
Everyone and their mother moved here. Yeah, it's awesome. Like you said, it is a hub for the Big Ten. Me and a ton of my buddies from IU ended up coming here. Again, yeah, it's just a hub. It's a hub for Big Ten schools. And so I moved here because I got a job working in real estate private equity for LaSalle Investment Management. So I was on their transactions team there for a few years, 2-3 years. And then even more recently, I wanted to get some development experience, some client facing experience. So I left and did development advisory. And so there I got a lot of client facing experience, and that sort of led me to where I am today, where I've recently launched my own real estate consulting program.
So you started at LaSalle.
Yes.
Like, I heard there's just even a tough interview process there. Like, what was it like? I mean, they're the big of the big, I guess.
Yeah. It's very competitive. It's you against probably 50 other kids just like you. And when you get to those when you get those opportunities, you got to make the most of them, right? Because everyone that they're interviewing is coming from a great school, has a good background, got good grades. You know what I mean? So you got to find a way to separate yourself from the pack. And luckily, it felt like a fit to them and for myself. And I got it. And I was pumped, learned a ton there, met a lot of great people, super appreciative of that opportunity.
So what insight into real estate did that role give you?
Oh, man. I mean, doing the work, I got firsthand access to people that have billions of dollars in transactions and have 25, 30 plus years of real estate experience. And I've seen the cycles that real estate does. And I got that at 22 years old, right? So I sort of was able to lean on their expertise to kickstart my understanding of real estate. And so when working in the atmosphere, you get a ton of deal flow. I'm in Excel all day, every day, right? I'm talking to these portfolio managers that have managed the same portfolio for 10, 15, 20 odd years. And I get to really understand investor sentiment. So I came in 2022 when the interest rate environment was just a question mark, right? No one knew what the Fed was doing. The 10-year was bouncing all over the place. Everyone was sort of on the sideline. So I got to see a really, really odd time in the institutional space of real estate, which I found really attractive because that really made me, tune in to what investors need to see, what a certain portfolio needs to see, whether it's, NOI, return on income, or 10 years, 10-year appreciation, right? It really just helped me understand investor sentiment to a very, very high degree.
What are you mentioned institutional investors, a lot of our guys own anywhere from a 3 unit to 500 units. What are some of the differences? Like, what are some of the things that institutional investors are looking at that doesn't even come across the mind of someone who's building a small portfolio here?
Yeah, absolutely. So in the institutional space, we can all agree that it's pretty, I would say it's pretty efficient. The institutional space is efficient. We can all agree that everyone generally has access to the same information. Whereas in the non-institutional space, there's a lot of mom and pop owners that may not keep up to date with market rents. And therefore there's a ton of hidden value in the non-institutional side versus the institutional side. And in the institutional space, these guys are acquiring real estate based on what their fund allows. So it's not necessarily you see a good deal, you buy a good deal. A lot of good deals that we hunted at LaSalle, we had to pass on because it didn't fit what the needs for our clients were from a portfolio standpoint. Diversification is really key. You can't be overweight office or overweight industrial in a portfolio that, is core assets. You have to keep a level diversified portfolio, which is very, very different. It's a different world, different beast in the institutional side.
Yep. What other markers might there be for the buy box that might be different than just us finding a good deal?
Yeah, I would say, price points are, at least where we played, price points are very different. Bigger purses. So for example, if we're looking at an industrial property, in the core space. And LaSalle by nature they were a core investor. So they invested in the best properties in the best markets, right? And essentially got a return, a cash return or an income return on their money over the course of 7 to 10 years. So for example, if we're looking at an industrial building, right, they're really keying into the tenancy. All right, what's the tenant credit look like? What's the WALT left on the term? If, you may buy in at a 4 cap, right? But there's 2.5 years left of WALT, weighted average lease term. And so once you roll the market after 3 years, that 4 cap may turn to an 8, right? And so that's where the hidden value is that, if I didn't get that experience in understanding real estate to that level, I may not have, learned that in just the non-institutional space where I see a dollar value and a good basis. And that's sort of what kind of makes you pull the trigger.
Yeah, it's got to be nuts looking like on the residential side, a 500 unit building predicting rental growth. Like that's where you can get destroyed, right? Like
there's a lot of people that got destroyed.
Yeah, like you're predicting whatever 3% growth on rents that are already 2,000, 3,000. It doesn't happen.
Yeah,
on a 3 unit, whatever. It's a lot of money on 500 units.
No, absolutely. And with LaSalle, they were big enough in the space to where we had a research team solely dedicated to figuring out what rent growth looked like in specific markets over a period of time. So when I would underwrite a deal, say there's a 150 unit in Charleston, in South Carolina, I'd go to my research team, that research head, and say, hey, look, we're looking at this deal. It's 150 units. What does market rent growth look like, over these next 3 to 5 years? Because to your point, it's so important and it can make or break an investment.
How did a big company like that find deals? Like, how did their flow go? I imagine they had to have a combination.
It's deal machine. You just drive around, send out a few flyers
for dollars.
And that building's got a couple empty offices that's on it.
The flyers that have like the cash on it, cash now.
Yeah.
No, 700 unit building.
So the acquisition officers, those were sort of our deal heads, our deal hunters, and so they've had years and years of experience in building relationships with brokers in the space. So a lot of times brokers would come to us and say, hey, look, so-and-so, there's a great deal, an industrial deal, 1 million square footer in Bourbon, Kentucky that, has a really good in-place cap rate that there's a lot of upside on. Do you want to take a look? So a lot of times in that space, specifically at LaSalle, given their relationships, deals would come to us, which was very attractive.
Yep. What would be like the smallest thing you guys would do?
There were smaller funds, right? We had funds that, had $10 billion to deploy, but then there were also funds that were targeted on small medical office buildings. So it could be anywhere from a $15 to a $30 million deal. It's crazy. And when I joined, $15 to $30 million, I was like, what? That's crazy. That's a lot of money. But after looking at all these transactions and doing, $80 million, $150 million transactions, that is sort of what a bite-sized deal looks like for them in their space, that $15 to $30 million space.
But that's what I love about it, because those $15 to $30 million space, like that's not even their bread and butter. They want the bigger stuff, which means they're probably not paying as much attention to the 15 to 30 million, which means there's room for the middle. There's probably 3 tiers, right? Of like the investors that are putting together those type of funds. The 5 to 10, 10 to 20, 20 to 30. Like, so
exactly.
That just means there's room for people listening to this show to be able to grow into those smaller funds and still be a billionaire someday.
Definitely. Absolutely.
Yeah, even now, like the 6 to 8 units I buy, that's too small for a lot of the bigger guys. Like the big players in Chicago, if it fell in their lap, they'd take it. But for them, it's like, nah, it's not big enough. And
it's not worth their time.
Yeah,
exactly.
Which also should make anyone listening here thinking like the whole concept of 10x is easier than 2x. So if you're going to raise
that is correct.
If you're going to raise 10 million, fuck it, you might as well try going after 30.
Yep. Exactly. One man's trash, right?
Yep.
All right, so we're engaged here in real estate. We're doing, we're working our ass off at the company. At what point was it out of college? You're like, all right, I'm going to own something. Like that becomes a reality for you. Talk to us about your personal venture here to get that first 3 unit.
Definitely. I would say when I changed my major to real estate and finance, I sort of made that decision to own real estate.
That one day you'd be on the Straight Up Chicago Investor podcast.
I knew it. I mean, Friday, right? I knew it was going to happen on a Friday. I knew I'd be here in front of you guys. I knew I'd be wearing this shirt, these shoes,
it was on the vision board.
Exactly. No.
This is yours in my head's on his vision board. Or the shoes.
Yeah, the shoes.
No, so I sort of made that decision in college that I was going to own real estate. Luckily, I had a professor, and he's still a mentor of mine today, that sort of pushed that on us, own real estate, buy young, right? So once I graduated, I knew that was my plan all along, but I just had to have the money to do it, right?
It's so funny. Like, it's so simple. Oh, your professor, like, I could ask more questions about it, but at the end of the day, it all chalks up to own real estate and do it sooner.
Yes, exactly. No, exactly. I mean, that's what I took from it. He said a ton of other things as well, but
that's all you needed.
That's all I needed. Exactly.
Buy as much as soon as possible.
Exactly. And benefit from, long-term holding. And so when I graduated, I had a plan to save for 1 or 2 years. It ended up being 2 years. I had obviously a good W-2 that I could, save a little extra monies every month. And so I kept stacking for those 2 years. And went in with a partner. Actually, I call him my business partner, but he's actually my best friend for the last 20 years. And, so we've kind of tackled this thing together. So we went half and half on our first deal in Logan Square, and we house hacked it, and that's how we got our start.
That's awesome. All right, we're in Logan. Let's hear the deal now. Let's break it down.
Yeah. It's sort of North Humboldt Park, just south of the 606 trail, right off of Kedzie and North Ave.
I know exactly where you're at. Yep.
Yeah, just right there. It's a 3-unit building on an extra long lot. So our lot is 25.
Those lots are all long in that.
Yeah. It was awesome. And, when we were buying it, we didn't quite understand the value of an oversized lot in Chicago. There is value attributed to that, and you can see it when you're looking at your appraisal sheet, right? There's going to be an adjustment towards, in the positives for that extra large lot. And so our lot's a 25 by 177, and normal Chicago is 25 by 125. So we've got the actual building structure, right? And we got a 2-car parking pad behind our backyard area. And then behind that is a 2-car brick garage, so there's a ton of value there. We can build out the garage into another unit. We're renting out the entire garage to my guy, Rick. He's been there for about 20 years now. He's awesome. And so he stayed with us. But yeah, we saw the value in it and acted on it as soon as we can.
I'm trying to blank on the street, but there's one street that's got some magnificent, like, coach houses on it, like right in that little stretch right over there.
Spalding's great. Sawyer. There's a ton right there.
I know we got a couple on that street, but yeah, like there's some, like, those deep lots they have, especially I saw one. I'm totally Cortland and why am I trying to blank on the other street? But it's a corner lot in the alley, so they actually have 2. Like, I'm sure it wasn't legal, but they have 2 coach houses coming off the alley.
It's awesome.
Yeah.
Oh, that's awesome.
We had one like this. It was the 2400 block of Albany. And we made the mistake. It was a single family flip that we were doing, but we probably spent $80,000 in the backyard, like, because we're like, all right, we're gonna make this oasis, and like people are like, oh, that's nice.
Yeah,
we like it this way and tear it up. I was like, oh, all right, well, swing and a miss. Like, but like, yeah, it's just you take it for granted until you see like you go into someone else's yard and you're like, this sucks.
Yeah.
Like, so all right, so. This probably wasn't the first one you looked at. Like, talk to us about the journey to get there, then we'll talk about some of the headaches.
Ooh, so yeah, I'm a true believer of put in your 1,000 hours of just underwriting deals and understanding what a good deal looks like. So I did that. Luckily I had the W-2 where I was always looking at deals, nothing that I was going to buy at the time, but still just analyzing deals and understanding where to find value. But I would go home every day and look. I was addicted almost of just looking at deals. And so I did that process. We had our money together. We met with Dan, my agent, and understood.
Full name, give him a shout out.
Yeah, Dan Nelson, man, great agent, investor friendly, invest himself. Couldn't ask for a better agent. So
he's awesome. He's just sent us deals that refer to us lots of property management. So
dude,
definitely
he's great.
Shout out to him.
He's great. And so I'm looking at deals on Zenlist, the MLS friendly software that he set us up on. And I'm looking at deals. It's a Thursday afternoon, right? I'm on my way home from work and I find this deal, $625,000, it's the deal off Kedzie, and $625,000, 3-unit. I'm like, that's a $208,000 a unit. That seems pretty good. Let me look into this a little bit, right? In-place rents were super low. I'm doing my research on rents. This is all happening on the bus, and I'm doing my research on Zillow, looking at, okay, what are some other rents going for in the area? I'm like, dang, these are way below market. Let me let me look a bit in more closely to this, right? And so I request a tour. We get in on Saturday morning. We get there Saturday morning. We end up offering Sunday afternoon, get it accepted Monday. So from start to finish, I say start to finish, we didn't close, but from start to offer acceptance, it was a 4-day period. And so it was just quick, super, super quick. You got to move fast, have your team ready.
But you knew when that hit your phone and the Zendesk app, you knew these are the 3 or 4 things I need to look at and this is where I need to go to look. These things might just be as simple as Zillow, but you knew exactly what to do to qualify that right away. And I think that's what a lot of people, they vacillate between, is this a good deal? It's not a good deal. And then all of a sudden it's no deal because it's gone.
Yeah.
So that's huge.
Exactly.
It's also, and personally, that's the most fun part of real estate.
It is.
That 72 hours of just just chopping it up different ways. What else can I do? How
and if
can
you
we...
don't feel fear, then it's not probably the right deal either.
Yeah.
Or you're missing something.
Yeah.
Your rehab number is way too low.
Yeah.
But yeah, like that said 72 hours or whatever it is, like that is like the coolest part there. Like just looking up all the different things and figuring out like, all right, what can this end product be? That's so fun.
It's riveting. It's riveting. And again, to your point, yeah, you should be skeptical because if it sounds too good, it's like, am I missing something here, or is this just a good deal? It's so hard to find a good deal these days.
Yep. All right. So, was this a clean closing? Anything goofy? What for those looking to do?
Why was
exactly
the seller
what you did?
selling? Talk to us a little about the transaction.
Yeah, it sounded so. We learned throughout the closing process that they were actually 1031ing the building. So they put it on the market with a broker that sold single family homes and didn't really have much experience in the multifamily space. So they priced it to sell is what I'll call it, to our benefit. And yeah, again, we found out that they were 1031ing the sale. So they wanted to move quick. We put in an offer at full ask, and can't argue with full ask when you're 1031ing,
Yep.
So they had a quick timeline.
Any challenges here? How smooth was it?
Yeah, again, this is our first deal, so everything that came up was like, oh, what? You know what I mean?
Here's a 60-page inspection report.
Yeah. No, I'm with a highlighter looking at every line throughout that inspection report. You know
That's awesome. That's awesome.
Just like really taking it in, because due diligence is so important. And my first deal, I'm like, I can't let anything fall through the cracks, And so I'm looking through the inspection report. There's no foundation issues, no roof issues, which I knew were the biggies. But we've got some older furnaces, some older AC units, some cracks in the walls in the basement, which I've got a story about that one. But at the time, I didn't think it was that big of a deal. The 4 walls were still standing. You know what I mean? But yeah, from start to close, it was honestly a pretty easy process. I can't say that about my last one, but yeah, pretty easy process. The first one, they say it's the easiest, and it only gets harder. So,
well, talk to me about this, and maybe you want to chime in too. A lot of our listeners are buying these 100, 120-year-old products.
Yeah.
And they're looking through that inspection, and there's a lot of things on there that are important. There's a lot of things on there that just, it's a 120-year-old home and you don't have to freak out about.
Yeah.
What are some of the things that are on there that you're like, it is what it is, 120-year-old home. I can't do anything about it, or I'll do this down the road.
No, exactly. Our first deal was 1890s build. So, I mean, old as dirt, right? So with one thing that we noticed was the stairs leading to the second floor apartment, they were slanted, like major slant. I mean, if you were standing upright, you may tilt one way or another, right?
He's too young. He doesn't remember V8 commercials. Remember those?
Yeah.
So
we lost 80% of our listeners.
So in my mind, I'm like, oh, it's foundation. It's got to be foundation, right? I didn't really understand that with these older homes, they just settle sometimes, and you may have a little lean. It's character in the home, right? And so after reading that inspection report, I'm thinking I should be expecting something with the foundation, but yeah, no foundation problems, which was nice. Yeah, I would say, the big two when looking at the inspections report for these older homes is foundation and roof life. Hopefully you can get some information from the sellers. In our situation, they didn't have much information to provide on the age of some of the heavier capital items, the HVAC units. It's central AC and central heat, which is nice. But the furnaces, they didn't really know how long and they've been there. They didn't know when they redid the roof. So we had to get some other specialists in to sort of tell us this. The furnaces were pretty easy because they have the plates on them. But for the roof, it's like, if you don't know and I don't know, well, how are we going to find out? You know what I mean? And so, yeah, we looked through those. Those are definitely the two biggies. Yeah, our inspection, our inspector that we use is a shark. So he's telling us if light bulbs are out. You know what I mean? So yeah, definitely focus on those two big ones. And yeah, your inspector will tell you if there's a major problem because you have to get an inspection before you close on any of these deals, or you should. I always recommend getting an inspection, whether you're buying the building as is or not. Still get an inspection, and if something's wrong, it should come up.
I think for me, you have that settling those stairs probably more often than not, unfortunately, and you have different dips in the units and all that. But I think for me, my number one red flag is when you start seeing the cracks like in the corner of the frames of the door frames or the windows. That means there's a bigger, like, now you're talking foundation versus you go down in the basement and jack it up a little if you get too crazy. But the stairwell you got to see get rebuilt sometimes. I've had to do that because the city told me I had to do it.
Yeah, I'll piggyback on too. Parapet's a big one. Like all the
parapet,
masonry work, the lentils, like those. That's just costly.
Well,
And like there's no like return on investment. Like ripping out a boiler and putting HVAC. All right, you got rid of your gas bill for the tenant. You can advertise central air. Like the lentils, and you got to do them, but there's no like ROI on that thing.
3-bedroom, 4-bath, updated parapets.
Not.
But here, let me tell you one
Actually,
more.
I'm gonna start advertising like that just to see who I attract.
Yeah.
Just like
The parapet thing, though, where I always tell people is they suck to do, but if the city calls you out for it, you have to get full permits and all that. Even sometimes engineering, depending how it is. So that's a lot more expensive versus just making sure your parapets aren't on the radar if someone's from the cities that are walking your property.
Definitely.
Yeah. All right. So we house hack. Everything's hunky dory. You get a tenant in there, I assume.
Yep.
Like life is great. What's next?
Yeah. So we closed on the deal. Again, all of the units were way below market value at the time. And again, since we're house hacking, we had to move into one of the units for a year, at least a year. And so we chose the top unit. Luckily, we negotiated during the sale process that the owner, the current sellers, had to terminate their lease in the top floor unit and, sort of get on the same page with the current tenants in that top floor to make sure they knew that they had to leave and find a new place. So when we came in, the garden unit, 3 units, the garden unit was rented out for $545 a month. It's a 1-bedroom, 1-bath, $545. Yep. The first floor unit was a 3-bedroom, 1-bath rented out for $1,495. It's Logan Square area, right? And then top floor unit didn't really matter because we were moving in. It still matters, but we didn't really think about it too much at the time. So how we did it, and we ended up keeping one of the 2 tenants that was still in the building because, how we like to have a conversation with our tenants is we came to each of them and had our purchase price. We like to be really transparent with our tenants. We talked about our new purchase price, what we bought the building at, what that then does for our real estate taxes, and our mortgage amount. We don't give them the exact mortgage amount, but because we bought it at a higher price than what the current owners had, we have to pay a higher debt service. So we're very transparent about real estate taxes and purchase price, and then we come to them and say, hey, 1-bedroom, 1-baths in this same neighborhood are going for, at the time, it was about $1,300 a month. And you're at $545. So we give them as much information as we can and sort of sit across the table like this and say, hey, we're at $1,300, you're at $545. What seems fair to you, right? So by doing that, it's sort of a psychological trick of, whatever rent we determine, they kind of came up with it, right? Because they know, okay, $545 is way lower than $1,300. And so let's try to meet somewhere that works for both of us. Long story short, the $545 moved out because it's a tough jump to come up to $1,300, and the unit itself needed some work. So it ended up working out. So we transitioned her into her next apartment, renovated that unit. We spent about $5,500 on that unit. New flooring, paint throughout, new tile.
Did you guys do the labor, or did you hire somebody?
See, We hired someone. We have a great relationships with some contractors that we really trust, and we're not the handiest of gentlemen. I'll say that much. I trust them to do it better than us. And I've got a story for you guys about why we don't do things ourselves. But we ended up renting that out after renovation for $1,325. So a big jump from the $545 that she was previously paying. But the first floor tenant, she was at $1,495, and market rent for that area was about $2,300. And she was an older lady. We understand, she'd been there for 6 years, right? Great tenant, always paid on time. These are comments from the seller. And, we want to work with her, right? We don't want to push anyone out of their homes if we don't have to. That's not the business that we're in. And so we ended up coming to a middle ground of $1,900. So it's a pretty good jump for her from $1,495 to $1,900, but it's also a discount to the $2,300 that we could get if we put it on the market. So it's sort of a common middle ground, and we've kept her ever since. Marisol, she's a great tenant. She's awesome.
And a lot of people don't realize they're not just necessarily negotiating with you; they're negotiating with the rest of the market. So
yeah,
if they get to $1,900, but they still have to go down the street and pay $2,200, they're still further ahead. So a lot of times we always encourage them, like, please go check out the market. $1,900, like, you're not gonna get better than that.
Yeah, I mean, she's living by herself in a 3-bedroom, 1-bath. It's a big space, great apartment, updated appliances, what have you. So yeah, we truly believe that it was in her best interest to try to come up to a price that worked for all of us. And she's there to this day, and we have a great relationship with her.
What's the story? Let's hear the.
Oh my goodness. So one piece of advice I would give all rookies is to always check for running toilets. Okay? This running toilet cost us $1,500, and we're still paying for it to this day. So long story short, we had a leak in our top floor apartment, the one that we were living in at the time. There was water leaking on the floor. We're like, we're calling people. What could this be? Is it a serious issue? We end up calling my friend's dad, and he tells us that it's probably just a wax ring issue, right? So we're like, wax ring, we don't know what a wax ring is at the time, I'm like, wax ring, all right, let's see what a wax ring is.
These aren't expensive. We got this.
Yeah, it's
$4.
Yeah, $4, for a donut, right? I'm like, all right, well, we can do this, right? We can do it. And so my business partner and I end up removing the toilet, right? Getting all the fixings and everything to put it back on. We get it off. We set down the wax ring. We're scraping up the old wax, right? And then we're putting the new wax ring on. And we're like, man, you know what I mean? We saved some money doing this, right? And so we put the toilet back on, and we're cost effective, And so we end up buying just this normal plastic pack of bolts and whatever else to screw the toilet back into place from Menards. And we're like, yeah, we did this for about $50. Like, come on, pat ourselves on the back, right? We got the toilet on there. Wax ring is good. Everything's good. Stops leaking. We're like we can do this. We should start hiring ourselves on TaskRabbit and go make some money replacing wax rings. Yeah, I mean, let's go make some money doing this, right? We felt so confident. We're like, we don't need to hire people out for this. Just about 2 months ago, and this wax ring situation was about 7 or 8 months ago. It was some time ago, so it worked for a while. Just about a month or so ago, we get a message from our first floor tenant, Marisol, and she sends us a picture of right on top of her bathroom. So right on top of her toilet. The bathrooms in the building just go vertical, right? And she sent us a picture above her toilet, and it's just a balloon just coming out of her ceiling.
From the plaster.
It's literally just like this. Oh, I wish I had my phone so I could show you a picture. And we're like, okay, what could that be from, right? Something's leaking up there, and it's right below our toilet. So my business partner and I looking at each other, we're like, this didn't happen before we lifted that toilet up. You know what I mean? None of this happened before. And we end up taking the toilet off, and there's just tons of water and spillage, and it's very appetizing. You know, when you see that stuff and that sewage, nasty water coming out of your toilet. And that all came from us not knowing how to replace a wax ring, right? And so we end up having to get our contractor out there we have him replace a wax ring. You know, we're done doing it. He brought his bolts and everything. We see it. We saw it.
Not plastic bolts?
Yeah, not plastic. Yeah, not plastic bolts. And we saw it. We're like, okay, now we know what to do for next time. You know what I mean? So we might try it out again. Who knows? But yeah, he got the toilet all figured out. And we had to get our contractor to replace all the drywall in the ceiling of her unit. So it ended up being a $700 job, you know, from what we thought was a $50 fix, because we wanted to do the cheap route and, you know, had a big head on our shoulders.
I got a different story too. One time, similar building as a 3-flat. I get a call from the first floor tenant. I get a voicemail. I kept this voicemail for as long as I had that phone because this was a funny ass voicemail. But this voicemail was African American lady just freaking out, like she's saying she's gonna sue me because she has piss and crap all over her. What she did was she climbed up on the toilet.
Oh,
and
poked it.
She poked it.
No!
But she did it like with like a big knife. So she stuck it up there, went like that.
Why would you do that?
And it just all came down on her. And she sent a picture then too of like, this is shit, and he pissed all over me. Like I'm like, listen, I am sorry, but like, I never asked you to go do that. Like that sucks, man. Like we ended up taking care of her and we worked through her emotional stuff on this side. But man, the voicemail had to be like, as sad as it was one of the funniest like voicemails. It wasn't so much the situation was funny. Her reaction and how she was yelling at us was like the comical piece to it.
Oh my goodness.
That's
oh
great.
My goodness.
You mentioned plaster. That's another one too, like that I think is undervalued is drywall versus plaster. Going back to the other conversation, like I think that's people don't care at all. And like I put a huge premium. I mean, if I'm going to place whatever, but like if I'm helping someone buy like drywall versus plaster is like huge,
waterproof. The whole nine.
Ridiculous. Every turnover is just so much easier.
Yeah.
Yeah.
All right, so let's get on to the next one. What's the next purchase here?
The next purchase. So the last deal, or what we're looking for now?
What did you do after Logan?
Yeah, we bought a 4-unit building in North Lawndale. Yep, about 150 a unit, so 600,000. But what we really liked about this one was that it came with the side plot next to it, zoned RT4, 25 by 125. So we've got that lot for future development potential in the future.
Okay, so 4-unit side lot next to it.
Yep.
What did you house hack this one or is it pure investment?
Yeah, so it's an owner occupied house hack again. So we really tried to utilize our low down payment, these low down payment programs to maximize our cash on cash return, given that, you know, we're not necessarily rolling in it quite yet.
So let me ask you a question about the structure. So obviously one of you guys both go on both loans, or how'd that work?
Yeah, it's really good. So the first one we both went on it. And
did you set up an LLC? Talks about the whole structure of because I think I get the question all the time about the business relationship of trying to partner in. Because I was encouraged a partnership, but then I started asking those questions. I'm curious how you did it.
Yeah. Step one, make sure you trust your partner. That's how I would start, because at the end of the day, you know, if you're getting a 30-year mortgage on one of these properties, it's a 30-year marriage to whoever you're in on that deal with, you know, so you have to really trust them and trust their judgment. But aside from that, yeah, we went in on the first deal together, right? Which I don't recommend if you're doing it in a partnership. If one of you can take on all that debt and still have a good debt to income ratio and can do it on your own, then do it that way, right? Because even though we went in it together, the full debt amount, the debt obligation goes on my balance sheet, and the full debt obligation goes on his balance sheet. It's not like it's not like it's halved, right? And for this one, we did roll it into an LLC. And so we, quit claimed it, put it into an LLC. So now it's protected by that sort of corporate shield. But if I were to go back in time, I wouldn't do that yet, because we still haven't refinanced out of that same owner-occupied 5% down mortgage. And so if we were to go back in time, we would have kept it under our personal names, one of our personal names, even though we're still partnering on it, but waited to transfer it over into the LLC after about 5 years or however long it takes you to refinance. Because when you refinance under conventional loan versus a business style, versus being a business borrower, right? You're more likely to get more favorable terms, whether it's interest rate or down payment need, loan to value. So if we were to go back in time, we would have kept another person under our personal names.
One of you would have bought Logan on paper. One of you would have bought Lawndale on paper.
Exactly.
Yeah.
Yeah.
And most conventional lenders won't even do something in an LLC unless there's something
Well,
changed with that.
And let me call out here because this is very common, but like I think it's worth disclosing is, technically
Disclosing
like
or disclaiming?
disclosing. Disclaiming. We had this argument beforehand. If someone wants to chat us and say, what's the difference between disclosing and disclaiming, let us know.
Yeah.
Don't look on the internet too. Just tell us in your own dumb words. All right. So a lot of times people do that. They put in their residential, then they quit claim to the LLC. Like technically, you are in default of your loan docs there, right?
Definitely.
Like just I'm making this. Everyone does this, but like I want to be known out there. Like there's a chance the lender can say, "Hey, you can't do that." Which in that case, you go back to put in your name.
Yep.
It triggers the due on sale clause. That's the clause that you sign off on your mortgage that you don't think about or don't realize.
Correct.
That's the trigger.
Like that could happen. And everyone does this, no one does, but like I just want to be crystal clear out there so we're not just throwing out advice because that could, again, the way to do it is just go back into it or refi or whatever. But that is one of the things you need to consider. Your attorney is the first thing he or she is going to say to you.
And if my bank is listening to this, I'm talking in third person about two people that I know that did the same thing.
Yes.
So, yeah.
So, all right. So what's getting into Woodlawn, like different neighborhood than Logan? Like,
Yeah.
talk to us.
Lawndale.
Lawndale.
Lawndale,
I'm sorry. Talk to us a little bit about, for someone who's not familiar with the city at all and doesn't know, like, just give us a little bit of like compare and contrast.
Yeah, because I get this question all the time. The guy that's super successful in somewhere on the north side and they can't find a good deal anymore up there. So they're like, I'll just go to South Shore. It's like, all right, man, we got to talk first. Like,
Yeah.
It's very different.
I'll start by saying different strokes for different folks. It is a different beast, but still manageable. Your tenant pool is a very different tenant pool. Well, luckily we have great tenants at in our North Lawndale building as well. But when you have a building on the north side or northwest side, some of those more affluent neighborhoods, that's just a fact, right? People tend to stay long. In my experience, people tend to stay longer and sort of take a little bit more appreciation of their home. Not saying that people that live in North Lawndale don't, but in our North Lawndale property, I'll tell you now that we had a tenant move in for 3 days and now they're gone because of a dispute that happened and our unit was trashed. And so we had to come fix that problem. But long story short, it all comes down to tenant screening, right? There's good tenants everywhere. It's your job to make sure that you trust the person that you're bringing in your building to pay on time, respect the unit, and do what they need to do as a responsible adult. So at the end of the day, my answer is there's good tenants everywhere, but it comes down to tenant screening.
Yep. Makes sense. What's next then? Like comparing and contrasting those two,
Yeah.
like, where you stay in both areas, where are you looking?
Yeah, so we've sort of transitioned our buying strategy to be in those southwest neighborhoods, the North Lawndales, the East Garfields, the Little Italys, because, what's different aside from the tenant base from North Lawndale and those other southwestern neighborhoods versus the north side is basis, right? There's no way, I'm not going to say no way because it could be, but you're much more likely to get a way better basis per unit and overall purchase price and more bang for your buck in those less expensive neighborhoods than you are on the north side. That's just a fact. And so given our, what our investors like and what our dollar threshold for purchases is currently, it just fits better with those southwestern neighborhoods just purely from a price perspective. And we do see upside potential in those, southwest neighborhoods.
Yep. All right. So you mentioned your investors. So it's not just you and your buddy anymore. What's the structure?
Yeah. So up until this point, we've purchased all of our deals off our own balance sheet, like we spoke about before. But now we've sort of opened the floodgates to friends and family and other investors that want to invest in Chicago and invest with us. They see their vision, and that's that's where we're moving towards. We know to get to the place that we're looking to get, we have to scale, and it's just not a good use of your time and money to scale on your own balance sheet, in my opinion. Where we want to go and how high we want to fly, it just makes more sense to start to utilize other people's money and get more people in on our deals.
So a $20 million fund you started, you're saying?
Yeah, exactly.
Well, talk to me about structure, because a lot of people want to be doing that, but they're like, I don't want to do a syndication. You don't necessarily have to always do a syndication. Like, how are you structuring this? It's just kind of limited liability type stuff?
Yeah, it varies. So we've taken investor money as a preferred equity return. So they get a preferred return on our deals. So say
You go deeper on that. A lot of people
Explain
don't
it to someone who doesn't understand that.
Yeah. So if someone gives us $100,000, right? Here's one investor. They want a quick return on their money. Our value add strategy is to recycle money within 6 to 18 months. So that's go in, rehab the units, make it look better, go back to the bank and refinance at a higher value and hopefully cash out off of our other loan. And so that whole process, that 100,000 could be for renovation costs. It could be for help, down payment assistance, right? And at the end of the day, we promise them an 8 to 12% preferred return. So every dollar that comes in, they are going to get their 8 to 12% on that $100,000. Does that make sense?
How do you determine, do they have any equity in the deal?
So for this specific strategy that we've used, and I can get into our other one in a second, but for this one specifically, it's almost like they're just dead. Okay. Right? They're looking to recycle their money and get a return on their money within 6 to 18 months, because we have a lot of investors that have money tied up in funds that are 5 to 7 years, but they need sort of that quick capital, right? They just want to make money on their money as soon as possible and recycle their capital quickly.
And they're those interest payments paid monthly or paid at the end when things are stabilized?
Yeah. So those interest payments, generally we pay them monthly, but we also cash them out at the end post refinance with the promise of an equity multiple on their money. And that multiple varies by deal.
So they're getting the interest payment, and they're also looking.
And they're also getting
on that $100,000.
Exactly. So we may promise a 1.2x equity multiple. So they're going to get 120,000 back at the end of the day, but they're also making 8% on their 100,000 over the course of 12 months. So they'll make $8,000, so $28,000 on top of their 100.
So that 8, let's call it that 8 per, whatever that 8,000 number, that's guaranteed. That has no idea what regards to the deal. Then that $100,000, like any other investment, it's at risk. It can be 120. The deal can go south, and it can be 80. Like that's right. Like, am I?
Yeah, it is at risk. There's no. Technically, yes, it is at risk.
Well, not any deals.
Any deals. Yeah,
right.
Yeah.
Just
yep. And then,
but the pref return is a guaranteed. Like
guaranteed.
They're the
8%.
lender.
Yep. Guaranteed 8%.
Boom.
How do you determine if it's between? You use the range 8 to 12. How does that get figured? Or is that just individual based on that specific deal you did with that person? You might pay 8, you might pay 12.
It varies based on cash flow of the deal, the total deal size. Promising 12% on $20,000 is different than promising 12% on the $100,000.
Gotcha.
So that's where it varies.
So it doesn't vary per deal, or based on the deal. It just varies on the terms of that specific deal.
On the terms, yeah, okay. Exactly. But on the other side, we've began to target investors that either have a real estate professional. They qualify as a real estate professional, so they can essentially take passive losses and write them off against their W-2 income, or they have a lot of passive gains. So what we've done is sort of raised money and offer a 30-70 split, 30 to the general partner, which is us, and 70% to them, using an 8% preferred return again. But at the end of 3 to 5 years, when we refinance, that's when the equity multiple kicks in. So they own 70% of our deals and can write off 70% of the losses that our deals generate, whether it's through depreciation, what have you, against their other passive gains. And then after 3 to 5 years, when we refinance, they cash out completely out of the deal for an agreed upon equity multiple, and we keep 100% of the equity. Is that?
So are you the only GP, or are you doing this with your best friend still?
Still both of us. Yep,
okay.
Still with my friend.
So let me walk through some scenarios then, right? Some what ifs.
Yeah.
So the 30-70, like, you're not getting paid until that multiple hits, like, right? Like, or how does it work up until that point?
Yeah. How it works is so if we make $100 a month in cash flow every month, they get their 8% preferred return on their 100,000. So they'll get, if we make 100, if say they invested $100 and we cash flow $100 a month, they get their 8%. So they'll get their $8, and that 92 that's left over, it's a 70-30 split. So they'll get 70% of the 92 and we get 30% of the 92.
The debt gets paid first,
So
and then the percentage
exactly, and then everyone gets paid out. And so we're technically, on a good deal, we're making money too every month, but it's just less than what the LPs are making, what our partners are making on the deal. But again, where we see value being so young in the game, we have, Lord willing, we have time on our hands, and so we really make the money at the exit, where we retain 100% of that equity moving forward.
And then what do they need? Yeah, so that makes sense. What cashing them out though? What does that have to look like on that 100,000? Is there a certain multiple, or what's the
and the time frame too?
Yeah, time frame for stuff like this is generally after 3 years. Depends on what markets we're playing in, but call it 5 years comfortably. We generally promise a 1.25 to 1.5x equity multiple at the end of the day. So if they invest $100,000 with us, after 3 to 5 years, we have a buyout option in the if we don't have to buy them out, but we have an option to buy them out at 125,000 or 150,000. And so they've made their 8% preferred return for the 5 years and capitalize off of those depreciation losses that flow through to our investors. But at the end of the day, they're also making an extra $50,000 on their principal investment.
Got it. Makes sense. Yeah, sorry, not meaning to grill you. It's just this is something people ask this stuff all the time. That's why I want
there's a lot of
details.
ambitious people listening that they don't know how to do. They don't even know how to even start that. So if anything, it's huge.
And it's really attractive to a specific type of investor. So we target people that have passive gains that they need to offset, because if you're not a real estate professional, these gains or these losses that are going to pass through to our investors, you won't be able to write them off against your W-2. So we target people that have a lot of passive gains, whether they're an angel investor in a company or a laundromat, and they're passive, but they're still making a ton of money, or they have money invested in syndications where they're getting dividends. And so those losses that we're able to pass through, those passive losses, could then offset their passive gains. And on paper, they make nothing. So it's really attractive for those people who need to find passive losses. And it's tough because passive gains a lot of time come from real estate, and they're already using those depreciation benefits and everything from the real estate that they bought passively. But for business owners, similar, maybe like yourselves, those passive gains, they need to offset it somehow. And we try to solve that problem through real estate.
So that's beautiful. You just did the math problem for everyone listening. But the other real problem that I see is I don't know anyone that has money. I don't know how to find someone that's got passive gains. How have you gone about? Obviously, you went to school for this. You had a small stint at LaSalle that probably gave you another education on it.
Yeah.
How do you exercise this practically in the real world with your partner?
Yeah. So social proof has been key for us. Really creating buzz through social media and getting opportunities like this one really helps get the word out of what we're doing. I say that's step one, you know what I mean? And having a track record is so important to these investors, because why trust someone's story, or trust them to go make you money when they haven't even done it on their own, right? Our value prop is that we've used our own balance sheet doing this stuff. Like we put our money where our mouth is and have done it successfully. And now we want to help you.
And you're educated in it too.
And we're educated in it too. We have the background, right? The transaction experience. That experience definitely sets us up for success.
So how do you go? Who do you go to? Do you start with family and friends? What happens when you get past family? There's a lot of people like, I'm an orphan.
Yeah. For sure.
Are there?
For sure. You'd be so surprised how many people with money, or maybe their friend has money, or maybe their friend's aunt has money, that want to diversify into real estate. You'd be so surprised. I task every listener with going through your contact list and asking yourself, do you think they'd be interested in real estate? Yes or no? Do you think they'd be interested in talking about real estate? Yes or no? Right? And go through your friends who you drink with on the weekends and ask them, because you'd be so surprised how many of my buddies want to invest with us because they see what we're doing, they see us succeeding in it, and they're super jam-packed busy with their W-2 jobs, but they have high-paying jobs and are saving money on the side, and they want to put that money to work.
I ran into this problem last year. We raised the $4.5 million to buy an industrial building up in Mundelein, and I thought, no problem, it's easy. I'll go get 6 and we'll be safe. Like, I never realized how many operators I knew. People like you. They're like, no, dude, I
got my own thing going on.
Yeah,
man.
I got my own thing going on. And it's like, oh shit, I know no pass. So there is a big difference in your network if you're rolling only with operators versus the passive people. I realized. And the funny thing is, like, over the years, like, yeah, let me know if you're against it. I'd love to passively invest. And they're like, I don't remember any of those people. I mean, hundreds of those people. If I only just keep a list, maybe that's the tip right there. Keep a list. And if this is something you plan on doing, keep a list of who you think is passive so you can follow up with them half a decade later.
Absolutely. Absolutely. Highly, highly, highly recommend. Ask your friends. You know what I mean? It's a tough conversation. I feel like people are very uncomfortable talking about money, but
there's larger stakes though when it's your friends and family, though. I mean,
for sure.
Maybe it holds you more accountable, and maybe you work harder, but that's scary too.
Absolutely, and that's why we're so confident today. Is because we didn't feel confident taking money from people that we loved and appreciate. When we first started, because we weren't sure if we knew how to do this or not. You know what I mean? I'd much rather lose $100,000 of my own money than $5,000 of my friend's money.
Yeah.
Cool. Anything else to cover here?
No, people ask us all the time, or like, how much because we do the management side, like they think like we're going to take care of our handful of properties more than theirs. I'm like, listen, man, like, yeah, I take care of your stuff far better than I take care of my own stuff and make more cautious decisions. So,
oh yeah, like the rentals I have by myself, those are the ones that's all right, fine. I'll just like
yeah.
way more loosey.
I'll just write the check 2 weeks from now and worry about it then or whatever.
Yeah,
it might be like,
exactly.
So, all right, cool. Let's wrap.
All right, cool. All right.
Awesome.
What's your competitive advantage thus far? How have you been able to do this while others wish they could sit up here and talk about what you're talking about the way you're talking about it?
Yeah, definitely. I would say experience. Having experience at LaSalle and doing it in the institutional space only sets me up for success, that much more success in the non-institutional space where not all information is shared equally and you can have that competitive advantage. But also team. Right. I've got a great team. My business partner is awesome. I would not have been able to do this without him. And also our agents, contractors, lenders, build a great team. If you have a great team, there's no way you can fail.
Yep. All right. What's the one piece of advice you would tell someone that has yet to buy the first property here in Chicago?
Yeah. If you're on the fence, my best piece of advice would be to, if you're going to miss the bus running. Right. That's the best thing I could say. You got to jump in that water at some point if you want to learn to swim.
I like it. I'm trying to like comprehend it around. I was like, yeah, that's good.
It reminds me of another guy I know is investing tons. He had tons of debt and he's had like 70, 80 million days. Like, you don't want to go so bankrupt.
Yeah. What's the worst that can happen?
What do you do for fun?
A ton of things. I'm a 25-year-old guy, got a lot of buddies in the city. We like to go out, eat, drink, have fun. But also, come August, a lot of guys like myself, fantasy football comes around.
I just
draft
around the corner.
Yeah, draft right around the corner next Sunday. I got 7th. So we'll see what I can do with that. 7th is going to be interesting this year. There's some guys that may fall, in that area.
This will be all right. Who do you think you're going to draft? Because this will air after your draft. So put it out there right now. Yeah. Who do you think is going to fall to you at 7?
I'm hoping CD falls because CD's projected like 5 or 6. I'm hoping CD falls or Jahmyr Gibbs falls, or I could even settle for a Derrick Henry too at 7.
Can't wait to see now.
Yeah, awesome. Yeah, we'll see, dude. My friends are sharks. Hopefully they won't hear this. Maybe let's cut this out.
They won't hear it. They won't hear it afterwards.
Yeah. Okay, awesome. Yeah. They're sharks. So I have no idea what strategy that they're gonna come to the table with. So I gotta come prepared with a lot of different audibles.
There you go.
How about that? He didn't ask to cut anything this entire episode, but he's worried about the fantasy football.
It's the most dude thing ever. And it's great. All right, give us a good book, podcast, or self-development activity you'd recommend to our listeners.
Yeah. Good book. I would say I have two. Not necessarily real estate related, if that's okay.
Yeah.
One is A Long Way Gone by Ishmael Bey. It's about it's a autobiography that it's a book that he wrote about his life as a child soldier in Sierra Leone. Super fascinating. It really puts your life in perspective. You know, when you get a flat tire on the side of the road, and you think your day's just shot, that would really set you back and say, look, it's not that bad. You know? Shoe Dog by
Phil Knight one.
Phil
That's
Knight, the
great.
memoir by Phil Knight. I think it's so awesome. I love that book. It's great. Just if you're an entrepreneur and you know what Nike is, which everyone knows what Nike is, I would assume, it's awesome. Podcast, Straight Up Chicago. Come on, like what
There
are
we
we talking
go.
about? What are we talking about? Like I've been a fan for a long time, listening to you guys on here, and I don't think anyone else. I think Chicago as a real estate market is different than any other market in the country, like vastly different, just because Chicago, if you don't know, it's a block by block city, right? You may have $1 million homes on one block and $100,000 homes on the other. And you guys provide the best real estate, Chicago focused real estate knowledge and value out there. So huge kudos
Thank
to
you.
you guys.
We appreciate it.
podcast.
Lance, make sure you clip that.
There you go.
No, it's awesome. It's awesome. Fitness activity. Oh, you said or.
Yeah.
I'm sitting here going through
Keep
all of
going.
them.
That's
yeah,
good.
I would say self-development, activity, exercise. I truly think that exercise is so good for not only your health, but your mental, your mental mindset and mental capacity. I use working out as a stress relief. I mean, as landlords, you guys know how stressful it is and that it is nonstop. People love to say real estate is passive, but that's just not the case. It's just not if you're a landlord and self-operating. But yeah, exercise, 10 out of 10, 11 out of 10.
Someone told me the other day, it's only passive if you're doing notes. So there you go.
There you go.
All right, other than yourself, name a valuable resource to Chicago real estate investors.
Yeah. To Chicago real estate investors, Block Club Chicago. It's a website that gives you neighborhood focused news. I like to read up on it every morning on the neighborhoods that I like to play in, and you'd be surprised what you'll find there.
I listen to their podcast.
Yeah, it's really good.
Awesome. Well, Micah, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah, if you are an aspiring investor looking to purchase cash flowing real estate properties in the next 6 to 12 months, but just need a little guidance to get there, help me help you, and follow me on social media at Real Estate with Micah, and let's jump on a call and make it happen.
Awesome. All right. Are you ready for the Chicago Fact? Who are we
Let's
playing
do it.
for?
All right, so we're playing for Jonah Whitescomb. And Jonah, if myself or Micah gets this question right, you get a $50 gift card brought to you by today's sponsor, Renovo Financial, the Workman Team.
There we go. Saw him last night.
Yeah.
Yeah.
Nice.
I got a picture with him. I got a picture between him.
You got a
and-
picture with Eric Workman? All right. We haven't talked about this on the air, but my Jefferson Park, Gale Street closed. I don't know if you guys knew that, the big rib place. So we took a hit over in our area. So now, which suburb is home to Chicagoland's oldest barbecue joint? Your options are Elmwood Park, Norridge, Oak Park, or Cicero.
Elmwood Park.
Elmwood Park.
Well, you could pick another one. So
What
Jonah.
was the second one that you said?
Norridge,
Yeah.
Oak Park, or Cicero.
Elmwood or Norridge? I was going to go Norridge. Is
All
that
right. Did
Russell's.
You? Yeah, you got
Bam.
it. Russell's, baby.
Oh, good stuff.
They have
Good
two. They have
stuff.
other locations now, but that one out there, yep.
That's so funny. Like I go through. I only probably go there once every year or something like that. But it's like I'm starting. I think about it every week now. I'm getting ready to go back there. Like we drive out from Madison all the time there to go there when we were younger. But all right, man, Jonah, awesome, man. You get a $50 gift card. Thanks to us getting that question right. Russell Ribs. Now it's Friday night. Maybe I got to do that this weekend.
Yeah, why not?
Renault Financial. Thank you for sponsoring, and you get a $50 gift card over to Jonah. So, wow, that was awesome. So, we talked about here today inspections and doing due diligence. Lots about that. If you are buying a property, you're working with your real estate agent. You get an inspection. If you want to share your inspection with myself or Tom, we'll look it over for you.
We will?
I'm going there because I think the assistance and looking around the corner. I think too many people get scared off by that, and they make bad decisions when it comes to getting that home inspection. And I think we have a unique look at it long term. So if you're buying a property and you want to send it over. You could message us or alert us over on straightupchicagoinvestor.com. So, Micah, thank you. Tom, thank you. Listeners, we'll see you next week.
Thanks all.